All right, welcome back, everyone. And it is time for what you've been waiting for. It is time to talk about PayPal and PayPal stock that has pretty much cratered since the last time I covered it. We should get right into it here. So, the results are not good. There are some people that prefer, good news first, or some people prefer bad news first. We're going to be going through what's bad first, and then see if we can salvage some good, because there's not a lot of good going on with PayPal. So just to remind everyone, the thesis that I've been sharing, the investment thesis for PayPal, has simply been that it is way undervalued. And it is still undervalued. We'll get into the valuation a bit later. It is still very undervalued, but the business is deteriorating at a rate that I did not expect. So I had to revise down my valuation by quite a lot. And we'll get into all of that. So I have some charts here we'll be speed running through. But first, the guidance. I think the guidance is the biggest reason that PayPal has been trading down. Of course, the CEO stepped down. The reasoning was PayPal was not executing quickly enough. And I can kind of agree with that. But given some commentary from former PayPal executives and stuff on X, it seems that the business culture doesn't really allow for, execution. And the new CEO, which is, currently the CEO of Hewlett Packard, HP, he doesn't really seem to be an executor either. He seems to be, one of those corporate, how should you call it? The one that simply optimizes the business that already has for shareholder value, while, simultaneously destroying any hope the business has for, growth, especially in a payment space that is very competitive, and a payment space that is just entering into like the next era of agentic AI and all of these things, things where PayPal really had a shot. And my comments on PayPal also, I think it's such a missed opportunity. I think PayPal, they were really positioning themselves well. They were talking about seamless checkout, being able to have your card information filled without even logging into any site, simply because they have that information vaulted. Positioning with for agentic AI, which, I just moved to Japan. I'm constantly using LLMs to, compare products, find products that I need to buy, furniture, refrigerators, all kinds of things. It would have been so nice if I could have just, bought them using an LLM instead of just, researching them. So it is clearly the next era of finance. And, they have partnerships with OpenAI, with MasterCard for enabling agentic, with Google. The partnerships are, quite vast, but we're not really seeing it implemented. Like, we're not seeing any material difference being made. And these are things that I've been talking about for a long time. So the CEO was let go, not executing fast enough. I wonder how much of that is the Alex Chris being a bad fit versus, how much he was allowed to do. So we don't know yet as of the time of recording this. But what we do know is that PayPal has lost further market share. So, people always say that PayPal has a lot of competition, and that is true. However, look how PayPal performed against that competition. So during all of these charted periods here, from 2017 to 2025, Apple Pay existed, Google Pay existed, Stripe existed, Adyen existed. Pretty much all of the sources that are listed as competitors to PayPal, they existed here. And you can see they grew their market share in the digital payment space globally from 13% to 16% by, COVID. Held that for another year, and then we embark on this decline. So from 16% down to 14%. So they are continuously losing market share because the payment space, the digital payment space, is growing fast. They had a sort of a first movers advantage, being, the scale that they are, and one of the first ones to, enable online shopping. That is quickly going away here. So losing market share, bad. Total payment volumes and the transaction take rate. transaction take rate has tanked further, now down to 1.66%. It was 1.72 the year prior, and this is what's commonly referred to as a race to the bottom for everyone in the payment space. So everyone that has a payment processing business is pretty much they're all losing take rate. It's not like someone is able to increase it because you choose PayPal over Stripe or Stripe over PayPal depending on what's cheaper for your business. Like that's pretty much how it is. And if you aren't able to make up the difference with some other value added services, like okay, we might be more expensive, but we enable this ads platform for you or stuff like that. So that's the only way to actually increase the take rate, by actually offering something that the competitors don't. But yeah, further downward trend there in the transaction take rate, not good. Another thing that I think a lot of people glossed over is that the actual payment transactions per active account has gone down. So we can see this trend. So this is the chart that I often refer to when I talk about my investment thesis for PayPal, is that they are getting more accounts, although slowly as of late, but each account is transacting more for every single year that is passing. So back in 2013, 22.8 number of transactions on average per account. That was up to 61.3. So even during that rough 2024, 2023, when the business was starting to slow down, losing market share, the accounts were actually still increasing their amount of purchases that they did using PayPal. That is now starting to go down. That is a red flag when you have a trend such as this. Next, the transaction take rate we already looked at. It is down to what was it down to? 1.66. Well, yeah, 1.66. And if you look at the long term here, you can really see what the race to the bottom is all about. Starting off here when there weren't really too many people in the space, and the price gouging didn't really start yet. The total take rate across the business was actually above 3.5%. Now they're both, I think 1.83 for the total take rate and 1.66 for the transaction take rate. And this will continue, most likely. Most likely, this trend will continue downwards. Not good. Another one that is a bit shocking to me is that during the transition year, that was 2025, where they were going to focus on improving margins, that was the sole reason, for they basically said, okay, we're gonna slow down growth, focus on increasing our profitability, but the actual cash that is being generated went down. The margins are down to 13% free cash flow to the firm. So not typically normal free cash flow, that's just cash from operations minus capex. This is looking at reinvestment needs for the business, down to 13%. Very bad trend, because this is what's used in intrinsic valuations typically. So when you're looking at cash flows, growth and risk, it all ties to the free cash flow to the firm if you're doing an unlevered DCF. And when you decrease the margins, that really hurts the fair value of the business. So that's going down, not good. And God knows where this stops. Is it going to decline further? We don't really have a lot of visibility because the guidance that we are given is not very pretty. Next, the transaction margin and transaction margin dollars. So this is what they actually said that they will be improving. And they did improve it. So they took a major hit to their growth in order to increase transaction margins by 0.5. Yeah, I was expecting a bit more here for the transaction margin. So that is not really, it's a rounding error. Sure, the actual transaction margin dollars increased, but this chart makes it look bigger than it is, because if you look at the starting point, it's 12.5, not 0. So the actual difference here is not that massive. It is less than 10 billion here. All right. Next, shares outstanding. Let's talk about some of the positive things that happened. So this chart also makes the bars look a bit more dramatic than they are, but pretty much cut 7% of outstanding shares year over year, which is, that's substantial. That's actually really positive for the business, that they're able to, allocate cash flow when the stock is seemingly undervalued. And they are guiding for 6 billion, which was the same for, the year prior. If they wanted to instill some confidence into investors, they probably should have increased that, especially now that it's trading, at 40. They should have come out with a statement, management should be buying if they really believe that it is truly undervalued. But perhaps they know something that we don't, which is why they didn't really accelerate the pace of buybacks. They're just keeping it constant. And now that we got the Q4 results and we know that we can expect a slowdown in the business, kind of makes sense. That they're keeping it constant and not, just taking out debt like something like Pfizer is doing. Free cash flow per share as a result, even though, free cash flow itself is not too impressive, because they're buying back so many shares, free cash flow per share is going up, which is positive. It's not a huge increase, 6.4 to 6.7. But compared to, historical periods, it is quite a difference. And one thing that surprised me, actually, is the average payment value per transaction. So the two core metrics here is the one we looked at before, which is, how many transactions are users doing per year, which we know is down. And then the one that ties into that is, okay, so what's the average payment value per transaction? And if you can keep, one growing and one constant, the business is expanding. Now we have one declining and this one is expanding, actually quite substantially. It's a big increase compared to historical periods here. It's been stuck around, $58, $64 range for the past 10 years or so. Now we have a massive jump to 73. So even though there are fewer transactions, the value on average is going up per transaction. And the margins, operating margins, net income margins, we see a slight increase. It's nothing major here for both, but at least they are not, deteriorating completely. They're not dropping off completely. So not too horrible on that end. And one of the major key or core drivers is Venmo. They've been talking about Venmo for a long time. We know that historically, the Venmo and PayPal teams, they were like completely separate. They were not communicating with each other. Under Alex Chris, the CEO that is now fired, he took it upon himself to actually start to integrate these two and actually have them talk to each other, and share. Which is still mind-boggling that they didn't do that historically. Like Venmo was growing very, very large. I mean, we're talking a quarter of a trillion in payment volume. And at that point in 2022 here, they still weren't really communicating. But, we can't really track that far back because they didn't share numbers. But from 2022 and onwards, they grew 9% in 2023, 9% in 2024, and then 12% here in 2025. Which, they are really guiding that this will keep improving. And as they start to monetize Venmo more, that will also trickle into the overall profits. But something that has actually grown even faster is other value-added services. So you remember I talked about, you have transaction revenue is how much you're making, per each transaction across the business. And then you have the other side of the business is what you're providing, aside from that. And we're actually seeing, quite substantial acceleration from 1% to 14% in other value-added services. Now, we don't have a complete breakdown of what that could be, but something like an ads business and stuff like that would go in this category. So basically any other value that you can add to your customers, your merchants, it is recorded here. And while it's still, relatively small percent of overall revenues, that did grow fast. And if they can keep accelerating that, that would be really good for the business. And with that, we are out of really positive news. So let's just talk about a bit of the, what has really transpired. So currently, PayPal is trading at 1.2 price to sales and 7.4 last 12 months PE. And that, equates to $38.8 billion of market cap. And they are doing $4.8 billion of free cash flow to the firm, this year. Now, as I mentioned, the real problem with PayPal and the reason it is down is their guidance. So we had the negative news of the CEO stepping down. Already, that's a red flag. Not stepping down, he was fired. But if we look at their guidance, they are guiding transaction margin dollars to go down. The only reason 2025, or the cited reason that 2025 saw such weak revenue growth, was because they mentioned that they're gonna focus on getting transaction margin dollars up. Now they're guiding it for it to go down without really guiding, overall payment volumes to accelerate. So payment volumes went down last year because they wanted to increase the margin dollars. Now both are down. So the trade-off is not really nice there. So in 2025, they grew revenues by 4.3%. That is not a lot of growth. 3.3% transaction revenue growth and 14.2% other value-added services growth, the chart that we just looked at. So while the chart we're looking at here. So while other value-added services are growing, transaction revenues are not, and we should not really expect them to grow. And PayPal does not guide overall revenues anymore, which is, also when you create uncertainty in your own stock by not providing, visibility into the future, not even like the next quarter, the stock tends to have a negative reaction, and that's what they've been doing as of late. We don't really get a lot of visibility. So transaction margin dollars got to be down in 2026. They're going to have an increase in operating expenses, which means that overall margins are going to go down. And they are actually guiding for a mid-single digit decline. So something like, 3 to 7, 8% decline in EPS. Now that last one doesn't really make a lot of sense because you're only increasing operating expenses by 3% and you're doing $6 billion of share buybacks. So, when you're saying that transaction margin dollars are going to have a slight decline, it doesn't really make a lot of sense that your EPS is going to tank by mid-single digits. So I don't know if they added that so they can, revise it upwards in the future. I don't know. Mathematically, it doesn't really make a lot of sense on that one. But that's really all we know about the business. We don't know. We haven't heard from the new CEO what he plans to do with the business. Is he gonna... There were some questions, during the earnings call, which, by the way, was also a complete disaster. They didn't really answer any of the analyst questions. Some questions were really good, like, okay, you are experiencing this, but let me see if I can pull up my notes. Oh yeah, so the key question was, I forgot which analyst, but I wrote this down. Is 2026 a transition year? And is PayPal a growth story or a capital returns company? So they didn't answer if 2026 was going to be another transition year. They basically said, well, we have no clue how it'll go or, for how long this situation will be like this. And for is this a growth story or capital return story? They basically said, well, we have unique assets and we are transforming the business and investing organically. Does that answer the question? No. Like they were dodging every single question. And it is, quite concerning for the overall business because, we talk about the market pricing PayPal stock for a deterioration, and up until Q4 that wasn't really too evident. So during my coverage of the company, I've been talking about, well, they're still generating a lot of cash. That is still true. They're still generating cash. They're buying back shares. They're not taking on debt to do it, but the market was still pricing PayPal for something like a negative 6%, revenue compounded annual growth rate, while also, a slight margin decrease over that same period. So the market is guiding, that PayPal will lose revenues every single year. And that is still true. Now, that is even further accelerated, actually. So I did another reverse DCF really quickly here. And what the current stock price, 38.8 billion, where it's currently trading, it actually implies a negative 9% revenue compounded annual growth rate. So every single year for the next 10 years, the market is pricing PayPal stock for declining 9% in revenue, which, of course, by what we know today, sure, the business story is deteriorating, the narrative is getting worse, but we're still not at basically negative 10% revenue for the company. And that is, calculated using a 13% free cash flow to the firm margin, which is what they're at in 2025. Now, given their operating expenses guidance to increase, 3%, that will take, a little bit of a hit when you're looking at operating margins that then translates to, free cash flow to the firm. But nothing is really signaling a negative 9% decline every single year. So the investment thesis still holds true that PayPal is undervalued. In fact, my fair intrinsic value for the company is now $76. So that is a 89% upside from where it's trading currently. And that is using a 4.9% revenue compounded annual growth rate. So that basically implies that they will have a few tough years here, but they are still early movers into agentic. They will still be able to capitalize and grow, but the payment transaction market, the digital payments market is growing at something like a 14% CAGR over the next 10 years. So they will continue to lose market share. Like even if they doubled the revenue growth from my forecast, they would still be losing market share because I only forecasted them to grow at 4.9%, every single year over the next 10 years. Not exactly, but, on average. And I have the free cash flow to the firm margin, free cash flow to the firm actually increasing by 5.1% CAGR. So profitability will improve while growth doesn't quite grow at the same pace as free cash flow to the firm margin. So is that still too optimistic? Well, maybe the truth is something between what the market is implying, which is negative 9% decline, and my 4.9% growth. Maybe the truth is something in between, which means that fair value is something in between. But with what we know today, there are still a lot of strong growth incentives. I think the ads business, if they can get that right, that alone is worth more than PayPal's market cap, because no one is better positioned than PayPal to actually have a solid ads business. I mean, they have vaulted a third of all cards in circulation currently. A third. They still have something like, they still have more than 10% of the overall digital payments market share. They still have, 400 million plus merchants. Like they have a lot of things going for them. And, they recently made an acquisition to accelerate the agentic AI adoption. They still have the partnerships that they announced. They just haven't executed on them. So they're still positioned to actually have some growth verticals. They're still positioned to actually start to increase margins. But I understand why the stock sold down. Like the Q4 signaled a real deterioration in the overall business. There's not a lot of confidence. We don't know what the new CEO will do. Analysts ask questions they didn't really answer. But they're still buying back shares. They're still generating cash. So there's a balance, and this is a difficult one. I would not be confident, buying shares in PayPal today, even after the sell-off. And that is not because I believe it is, overvalued or the market is right. I still believe it is undervalued, but you have to weigh your opportunities against every other opportunity in the market. I mean, we had actually super high quality businesses sell down. Like maybe you caught my Palantir video that I recently posted. We have Robinhood selling off massively. We have a complete monopoly like FICO also selling off. So you have this decline in PayPal while simultaneously actually super high, like the highest quality businesses in the market are also selling off. So you're like, okay, where should I allocate my capital? Well, for me, it wouldn't be PayPal. So I made some portfolio moves. They are shared on my here we go, my Substack. So for those of you that didn't know, all of my personal portfolio updates are on the Substack, and you can track them. Where I give the date, and you can track my allocations, my weightings. I give some commentary around what I'm doing. So you can track that there. And also on the Substack, of course, if you want to read some equity research, which I will be putting up, something more detailed about PayPal on the Substack. You can go here and read my, in-depth articles. I really recommend this Palantir one. And with that, let me know in the comments if you sold or didn't sell PayPal, because, some of the hyper bulls that I know, someone like Crossroads, Couch Investor, they've sold out of their positions. So let me know what you're doing with your shares. For me, the investment thesis is not broken from what I had before, but there's a lot more uncertainty introduced, and there's simply a lot of better opportunities while PayPal is also trading down. So with that said, thank you so much for watching, and I will catch you in the next one. Bye-bye.